This is a review, the state of the financial markets for what went on last year and where do we see or where we're headed in 2021. The market actually crashed, and Craig and I deem a crash happening of anything that's more than 30%. The idea was then looking at it in terms of how we're going to come back. Normally a recovery, it looks like a V. Sometimes that V, we roll around on the bottom a little bit so it looks more like a U. The one Craig and I were really looking at and considering, we're talking, May time frame, was the W. Market would go down, come back up, go back down again, and then head up. What I call the square root recovery. When we look at the S&P 500 from last year, we went down, came back up, went sideways for a while, and then jumped back up. So from when the dot-com bubble 9/11 occurred to 2006, that's what I'm calling the pre-housing bubble, the then chairman of the Federal Reserve Bank was Alan Greenspan. When the dot-com bubble burst and 9/11 happened, he did what the Fed is supposed to do, which is starting to move the interest rates down to make money more available. The problem that happened with that is that mortgage rates just went to someplace they had never ever been post-housing bubble. And you've got Ben Bernanke. He is now the chairman of the Federal Reserve Bank. Bernanke basically said, wait, we're gonna do what the Fed does and we're gonna lower interest rates. The problem was we got to a point where we got to zero. And so he adopted this thing called quantitative easing. Essentially, it is the government buying bonds and selling them back at the same time to push cash into the marketplace. The problem was when they did it at the housing bubble, when the collapses were occurring, is the money didn't get out into the street. A lot of those institutions took the funds and then put restrictions. It's supposed to loosen up lending, and they made it almost impossible to get a loan. So lending wasn't occurring, money wasn't getting out there. But what happened is interest rates became non-existent. Ben Bernanke at some point told you the only place your money is going to make anything is in the stock market. There were 19 times that a world market has crashed. If I take those 19 and average them all together, they look something like this. The top of the market to the bottom of the market is a decline of about 55% or so. It then comes back, this time span on average about 24 months. There's a downturn that happens, that's about 20%. Right, I'm averaging it. This is what the average looks like. We then get a period of volatility that goes for about 3 to 5 years. And then the bull runs. When I look at 2007 to 2009, and I lay that right on top of it, that's what it looks like. From 2013 to 2020, longest bull run that we ever had. Because we kept throwing money at the market, it just kept shrugging it off. It took a global pandemic, an absolute shutdown, to get this market to drop more than 20%. So this is really, it looks meaningless, this little chart here, which is just nothing more than the yields on the US Treasuries from 1 month to 30 years this year. And really what we're looking at is the 10-year Treasury. Now, the 10-year Treasury is a guiding light for lending, mortgages, that type of thing. You can see on January 6th, it went over 1% for the first time since March of 2020. 10-year Treasury usually averages somewhere around 4%. And you'll now notice that it's been ticking up. So here's the first forecast to be looking at. If this continues, if these yields continue to go, it's up another 20% in the yield, start flashing yellow. Because that's a warning sign that we're in a situation, a market pullback will happen. What it's telling you right now that the average yield on $100,000 will get you $200. Money is in the bank, is not going to earn anything. Interest is nowhere to be found and won't be for a while. What did quantitative easing look like back in 2008? The Fed is issuing and buying bonds with the idea that you were going to put an influx of money, cash, into the market. Instead of quantitative easing, we're calling it stimulus. Now, I will say this for the Fed. They did do something that is a little bit, I'll say, better than what quantitative easing was, where instead of having the money go to institutions, which are then lending, it's going right to the general public. It's money right into your pocket. Now you're going to go spend it. The problem is every time you talk or listen to anyone who talks about where this market is headed in 2021, one of the cautions they're going to tell you is inflation, that the market is at a bubble, and the fact that the stimulus money went to the individual and interest rates are at as low as they're going to go. They're really not going to be there. You're not really going to see any lending impact with this. But one of the concerns will be as we go forward here, this is trillions upon trillions of dollars. Somebody's got to pay for that. Tax money, right? That's how it's going to get paid for. It's going to get paid for with taxes.
Actually, the bubble's got to pop, right? Someone's going to be left with holding the bag.
Exactly. 92% of the investors out there feel this market is in a bubble. However, 32% think that recession is the number one concern for their portfolio. A real interesting one with this, which that's all, doom and gloom. Still 57% of the people are bullish on the market and the economy. These are four different scenarios. Now, in our scenario where we are right now, where we're really at very, very low inflation, pretty much almost non-existent. So it's the bottom two boxes that we'd really be concerned with, which is low and rising inflation and low and falling inflation. The Callan periodic table of asset classes. And what this is the last 14 years basically of returns, where you've got the top performing asset class on the top of the row, and then the worst performing asset class in the bottom of the row. The idea is if I spread myself out among all of those asset classes and did that every year and went back in and rebalanced every year, I end up in a much better, a less volatile position, otherwise known as asset allocation. It's finding a mix that's right for you and sticking with it as it goes along.
Have questions? Ask us. We can help with that. You can email Craig at crichardson@aresfoundation.org, or you can visit the website to learn more about what we do and how we might be able to help you. www.aresfoundation.org. Want to see more of this recording? Go to www.aresfoundation.org/events. If you know an organization or community support group that could benefit from one of our workshops, reach out to Tom T. Alessi at aresfoundation.org. Our mission is trying to help everyone have a better relationship with their money.